Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dugal. Let's get you the headlines this afternoon. Indian markets look set to post their longest gaining streak in more than 10 years as investors bet on an earnings recovery. The Indian rupee falls to a 7-month low against the dollar as surging crude prices trigger concerns about the impact on government finances. Infosys CEO Salil Parekh chooses growth over margins, highlights the need to grow presence in the Internet of Things segment. That's a Bloomberg News exclusive. Fosun International becomes the fourth bidder to join the race for Fortis Healthcare, puts in a non-binding bid to pick up 25% stake in the company. All right, all of that news coming up here over the next hour or so, but we start with the markets as well. Neeraj here with the market check. Afternoon, Neeraj.
Hey, afternoon. Well, if you looked at the markets, you would think nothing's wrong. Probably nothing is, but yeah, this will be the 10th straight day that we'll have an uptick if we indeed close at these levels, and would mean that we have about a 450 or 460 odd point rally on the Nifty in the last 10 days. That's quite stellar, really. But the interesting bit is that it's not really the heavyweights like banks which are participating. Now we've got a set of sectors that are participating. Yesterday, remember, it was a defensive bent which was doing well. The power grids, the NTPCs of the world were doing well yesterday. In today's session, ITC is leading the charge. So that one is about 3.5%. Z Entertainment about a couple of percentage points. But FMCG is now slowly and steadily starting to participate in a meaningful way. Cement could be interesting. ACC numbers today, and if they indeed speak about volume growth and utilization levels being better, could actually percolate very well for some of the others, which is why Ultratech, by the way, is up about a couple of percentage points as well, while ACC is, and ACC doesn't have index presence now anymore, but Ultratech about 1.5% higher. So that's one bucket of stocks which have doing well, and ITC is leading the charge. Look at the non-Nifty names too. The likes of Godrej Industries and a couple of other FMCG names seem to be doing okay. HUL was up about a couple of percentage points, so that's one bucket that is doing extremely well. Hotel stocks continue to rise and shine, and just look at everything from an Indian Hotels to a Royal Orchid, which has got a few hotels, to a Taj GVK, which is got about a hotel or two. But all of these seem to be doing really, really well for themselves and on very good volumes, I might add. Very interesting to see what the delivery percentages of some of these are over the last couple of days. So we'll watch out for that. Last but not the least, volatility has come off meaningfully. Day before yesterday, we were talking about 14.8, 14.9. It's just completely collapsed on not substantial gains on the markets, but 13.95, we are sub 14. So it's come off about 100 basis points in the last 2 days, and from levels of 16.3, 16.4 at the start of the month to sub 14. That's quite a steep drop in volatility as well. Remember, we were talking about 2018 being the year of the return of volatility. It is a bit subdued right now.
All right, Neeraj, thanks so much. That's the equity market check. The currency market's moving to a different set of triggers. The rupee has been one of the worst performers in the Asian segment for at least the last 5 days, even over a month, actually. A bunch of factors playing out there. Oil prices rising, US bond yields rising, perhaps. Let me get a view in on the currency markets from Anand Bagri of RBL, joining us on the phone line for a quick check. Anand, thanks so much for taking our call. What has changed in the last few days in the currency markets? Initially, there was talk about just mismatch in supply-demand because there was heavy demand from PSU banks. But has something changed in terms of the fundamental sentiment?
The most proximate cause seems to be crude oil, as you rightly pointed out. I think once crude breached the 70, 68, 69 level marks, I think there's been a lot of demand from oil PSUs. So that has really led to this rally in rupee. On the other side, where there were expectations that there would be FPI inflows after the increment in FPI limits, but so far we have not seen any major investments coming on the debt front also. In fact, we have seen a negative outflow of around 4,000 crores in both equity and debt in the last in the month till date. So basically, it's been more about the crude oil story, which is panning out as of now. And I think even if we look at the technicals right now, rupee seems to have made a inverted head and shoulder pattern, and I think overall. Direction seems to be bearish only in terms of rupee. I think it could touch 66.50 levels in the days to come.
Is there a global element to it also? But noting the fact that India is the worst performer of the last 5 odd days, even over a month in the Asian pack. But the global story is not particularly supportive of EM currencies either, is it?
The global story plus whatever US had mentioned about India intervening, I think the RBI also wants to play safe on the face of that. I think there's not much intervention we are seeing at these levels.
Okay. Is it also a little bit of, sort of adjusting to previous gains on the Indian rupee? We had gained a little bit more than we should have fundamentally. So perhaps it's just an adjustment in the currency.
It's basically catching up to that also. I think we would overall see a 4 to 5% depreciation in the currency. If you look at the interest rate differentials and the inflation differentials, I think a 4 to 5% depreciation is actually what should play out. But in the initial part of this year, I think mostly rupee remains strong only. So it's also catching up to that. Because exports have also been faltering, so I think there needs to be some readjustment in the rupee dollar rate.
Just a last quick word, Anand. So what is your range for the currency? I know you mentioned some technical levels, but what would you be expecting?
As of now, we are expecting between 65.50 and 65.80 for the immediate time, in the immediate time range. But overall, I expect rupee to touch 66.50 levels in the next couple of months.
Anand, thanks so much for taking our call. That's Anand Bagri explaining the currency market mood. The rupee hasn't been doing that well, at least in comparison to the other Asian currencies as well. 65, 66 on the Indian currency. Let's move on to corporate news. A Bloomberg News exclusive. Infosys CEO Salil Parekh believes now is the time to sacrifice margins and invest in advanced technology and skill development. In an interview with Bloomberg News' Sarita Rai, he says this would be crucial to stay relevant to clients in the future. Sarita is now joining us on the phone line from Bangalore. Sarita, good afternoon. What were the key takeaways from the interview?
Good afternoon. So he talked about a few key things. Of course, the overarching message was short-term pain for long-term gain. So he talked about how he's going to spend money on advanced technologies such as Internet of Things and autonomous vehicles, and also skills, reskilling the entire Infosys workforce to capture demand in the market for these technologies, as well as localizing the workforce in the key U.S. market, where it's also expanding its sales team. So those were the key things that I got from the conversation yesterday.
Any sort of conversation, Sarita, or anything you picked up in terms of all this discourse that started, that they are going to unwind some of what had started under Vishal Sikka, Panaya, etc. Anything you picked up on his mood around some of the steps that had been taken under the previous CEO?
Yes, in fact, I did ask him a pointed question about Panaya and Skava, and his answer was that Infosys internally, the leadership, took a look at the criteria that will sort of set the demand for, the future, Infosys. And Skava and Panaya do not fit into that set of criteria, and therefore the decision to mark down the price of Skava and Panaya by almost 70%. They bought the two of those companies at about $320 million in 2015, and now 3 years later, the value attributed to those assets is about $90 million, and that's a huge sort of write-down.
All right, Sarita Rai, thanks so much for giving us those key takeaways. You can go to bloombergquint.com to read Sarita's story on her interaction with Salil Parekh. Let's move on. Valuation guru Ashwath Damodaran would have approved perhaps of Salil Parekh's decision to cede margins in order to build Infosys of the future. In an interview with Neeraj Shah, the professor at Stern School of Business said chasing margins may not be the best thing to do for Indian IT. He said Indian IT needs to accept its age. Listen into a slice of that conversation.
Firstly, a piece that you wrote, which is about capital allocation across the world. And I believe that you mentioned that Indian companies over the last 12 to 18 odd months have now started catching up in some way to buybacks or payback of cash that they have. It's a very small percentage of Indian companies really which have that cash to give back. Right. IT companies probably feature in that list as well. But in the same breath, I believe you have mentioned in the past that Indian IT seems to be aging, or dying, whichever way you
Well, I think aging is a nicer way to put it, because they're not dying. They're still profitable companies. They're not JCPenney or GE. Right? Those are dying companies. Those are companies where the days are in a sense, you're marking time. I mean, Infosys is not going to go away, but in a sense, it's got to learn to live with the new reality, which is it's a mature company. It's got to behave like a mature company. It's got to be okay with the fact that growth might be single digits rather than double digits. What gets companies like Infosys into trouble is they try to go back to being growth companies. Because then you're going to find an ecosystem of people who will help you on that path, right? Bankers, consultants, because they're going to collect off your acquisitions.
Sure.
And I mean, I essentially, the analogy I offer is it's like a 65-year-old trying to look like a 35-year-old. You're going to find a plastic surgeon who says, I'll do some plastic surgery on you, but then gravity works its wonders. So I think that the big tech companies in India have had a good run. So in a sense, rather than complain about the fact that they've become mature companies, you've got to celebrate the run they've had to get to where they are.
True.
But their business model is reaching again the end of its glory days.
Sure.
Outsourcing had its benefits because you had a significant cost advantage from operating in India. One of the byproducts of Indian middle class incomes going up is that cost advantage has become smaller, and the fact that we've mechanized so much of the process has also meant that that cost advantage is dissipating around the world. And that effectively also means it's cutting at the heart of the business models for outsourcing companies. So I'm not surprised that growth has dropped off. Could they reinvent themselves? Yes. But to reinvent yourself, it's not just entering a new business and giving yourself a new name. You've got to rethink the culture of these companies, the way they think through problems, the way they take projects. And I'm not sure these companies will be able to do it easily. Some of them will, some of them will not.
But by and large, difficult.
By and large, it's really difficult to do.
In that vein then, Professor, does the average multiple, whichever multiple we look at, do you think that steadily comes off over time?
It does, but that doesn't mean the price has to come down, right? Because if the earnings keep going up,
sure.
So you might actually have a period of only 6% price appreciation, but 12% earnings growth, and over time your multiples will, but that should be expected. Your multiples of earnings at which you traded, and they've already come down if you look at the history of these companies
sure.
on a relative basis. You don't notice it as much because the market overall has gone up. But on a relative basis, these companies are much less highly priced than they used to be 10 years ago, 20 years ago. So the market's not being unrealistic if you look at it on a relative PE basis.
All right, on banks, Damodran says there may be more cobwebs in the cupboard. He compares the breach of trust by Indian banks to the situation created by global banks that led to the financial crisis in 2008. Hear him out.
How do you value stories which are looking doubtful right now? I mean, banks, for example, are a case in point, Indian banks. How would you, if you have a thought here, how would you go out and value some of these Indian banks?
Let's start off with the reality that business stories don't always have happy endings, which is some stories are not going to end well. I mean, without talking about Indian banks, let's talk about a company like JCPenney. There is no good story I can tell you about JCPenney. No story with a happy ending. This is a story that's going to end badly. Same thing with GE. This is the Bataan death march you're watching in slow motion. So sometimes you have to accept the fact that when you look at a story, the end game might not be a positive one. It's not going to end with. But there are a couple of ways this can play out. The first is that the worst of the bad news is out, and that what you're going to see now is an adjustment phase. And adjustment phases are never fun, because for a bank, an adjustment phase basically means you've got to bring your regulatory capital up and you get back to health. The key, though, is to make sure that all the bad news is out. My fear with Indian banks is we don't know the full story yet. And the problem with telling a story when you don't have all the facts is you keep getting hit with more negative surprises. And this is exactly what happened across the world with banks after 2008. In fact, I wrote a paper in 2009 on valuing banks, and I called it breach of faith. And the reason I said that is until the banking crisis in the developed markets, we entered into a Faustian bargain when it came to bank, we as investors. And the Faustian bargain was banks didn't give us much information, but we were okay with it Because A, we assumed that banks were run by sensible people, and B, we assumed that bank regulators actually did their job. And 2008 told me that neither of those assumptions was based in reality. I found that banks were run by some of the least sensible people on the face of the earth, people driven by inertia and old habits. And I also found that regulators were not doing their job. So I said in 2009 that the way I value banks has to change. The way I historically valued banks was I took their dividends and I assumed that they were run by sensible people, so I could value them based on dividends. And I said, I can't do that anymore because I don't know whether they're paying what they can afford to. And I think Indian investors have to accept that same recognition with Indian banks. They have to accept the fact that there's been a breach of faith, that they have to therefore do their homework rather than take the numbers at face value. You can't just buy a bank because it has a high dividend yield anymore. That's an extraordinarily dangerous way to invest in banks if you don't know all the stuff that you need to. So I think it just means that investors in Indian banks have to do their due diligence a lot more than they used to because we've had a breach of faith.
Right, interesting comments there from Ashwath Damodran. Speaking of banks, the new stressed asset framework, as you know, has been debated heavily between the Reserve Bank of India, the government and bankers. The government and bankers, as Bloomberg Quint has reported, has not been in favor of the new stressed asset framework, which is far stronger than any of the earlier frameworks. Well, the RBI Deputy Governor, Mr. Vishwanathan, was in Pune today. He seems to be defending that new framework. I'm just reading out some of the comments that are coming in from his speech. He says that the new stressed asset framework seeks to restore the sanctity of debt. The new framework nudges lenders to take timely action, and the new framework is more outcome oriented. In the course of his speech, he talked about the fact that a one-day default by bankers was seen as par for course, but it shouldn't be. And in order to restore the sanctity of the debt contract, you need to ensure that even that one-day breach is treated like a breach. You know, the RBI Deputy Governor trying to make his case, a lot of back and forth going on those norms, in particular on the fact that the RBI wants banks to start resolution, recognition as soon as a company defaults, even by a day on its overdues. Bankers are arguing that you need to give at least a 1 month leeway before you start resolution. So at least so far, it looks like the RBI is steadfast on putting those norms in place. Let's move on. The line of suitors for Fortis Healthcare just got longer. The company has received a non-binding bid from China's Fosun International. Fosun has proposed a fund infusion of 100 crore within 45 days, but that's on the condition that Fortis enters into a 1 month period of exclusive talks with Fosun. After due diligence, Fosun will consider a 2,300 crore bid for the hospital chain. Yatin Mota is standing by with more details from that offer. Yatin, the Fortis board is scheduled to meet tomorrow. They've got 4 proposals to consider.
Clearly 4 proposals, 4 expression of interest. Of course, they have now entered into talks with Manipal, and after Manipal, we had 3 players which showed interest. First was the Hero Berman Family Office. Second came in from IHH, which is a Malaysian healthcare company, and now it's Fosun, a China-based company, almost like an investor, which is wanting to buy the Fortis shares. Of course, they said that they'll not go anywhere above 25%, but their offer is basically 100 crores, to be paid, on an immediate basis within 45 days once the offer is accepted by the board. And after that, they are proposing to put in close to $350 million, or a sum of nearly 2,300 crores. Of course, the investable price that they've indicated at this point in time is close to 156 rupees per share, almost 4 rupees lower than what the highest bid or the highest price to be paid, to the existing shareholders of Fortis, which was close to 160 rupees by IHH. Of course, there are various, metrics through which a transaction can happen. Of course, the Manipal deal is slightly complex, but the other 3 suitors have, spoken about, a very smooth capital infusion, which will help them meet the working capital requirements. And not only that, various strategic initiatives like the delisting of the Singapore Healthcare Trust is what Fortis was looking at. So at this point in time, if you look at the best offer, it's IHH. But of course, other players like Fosun have indicated a price of 156, close to the current market price, at a very small premium to the current market price. However, the board will meet and decide as to what should exactly be done, given the fact that there have been 4 parties who have shown interest, and what could suit the shareholders of Fortis Healthcare is something which could be decided very, very shortly.
I think thanks so much for that. Electro Steel Steels will soon be a Vedanta Group company. The Kolkata NCLT cleared Anil Agarwal's 5,000 crore proposal for the stressed steel company. Electro Steel was one among the first 12 large corporate accounts brought under the Insolvency and Bankruptcy Code. While the lenders will still have to take a haircut, Nikki Mirchandani has done the math on whether the deal makes sense for Vedanta or not. Over to Nikki.
Thank you. It's a small acquisition that we're talking about for Vedanta. If you look at the way this deal has been structured, almost 34%, a total of 5,320 crore will be paid to the debtors, out of which 34% will be by the means of subscription to share capital. That's the amount of 1,805, and the additional 3,515 crore will be bought in by the way of debt. How the shareholding pattern will change after the acquisition. Before, we have right now the promoter shareholding of Electro Steel currently stands at 45%. And the public shareholding currently stands at around 55%. How will that change post the takeover? Well, Vedanta, through its subsidiary, will be holding around 90%, and the rest 10% will be held by the lenders and the existing shareholders. What Electro Steel has for Vedanta, it has an integrated steel plant, ductile iron pipe, and also potential for completely integrating the iron ore mines in East India. The total capacity of this plant right now is at a 2.5 MTPA, but then the existing capacity is currently at 1.5 MTPA, which means that Vedanta will have to ramp up the additional 1 MTPA capacity to achieve the complete realization that the company has witnessing, and also will have to fund in some kind of additional capex for that kind of capacity.
All right, Nikki, so is it a good deal for Vedanta?
Yeah, it's a steel deal actually, I'd say. We're working with an industry assumption of EBITDA per ton of around 7,500, EV to EBITDA at 6 times, and debt to EBITDA level of 3 times. If you look at the valuation math, the way it starts up, you will see Vedanta right now paying a sum of around 5,320 odd crore for a derived EBITDA of around 1,125, which brings us to an EV to EBITDA multiple of 4.7 times, which is way lower than the 6 times multiple that the industry has been assigned. Also, if you look at whether this will have any impact on the balance sheet, the debt to EBITDA ratio will actually reduce, in fact, after this deal. Pre-acquisition, we're looking at the debt level of 0.7 times. Post-acquisition, it will come down to 0.6 times, which is again lower as compared to the 3 times level, which usually the industry is witnessing right now. What brokerages have to say? Well, JP Morgan on Vedanta says it's unsure about the strategic fit though, but then the balance sheet can support the acquisition. Edelweiss on Vedanta says that this returns may be in excess of 20% post the acquisition of the deal, and CLSA says that deal is going to be more attractive once the complete capacity will be ramped up. Back to you.
Thanks so much for that, Nikki. Sticking with the insolvency, the resolution professional for ABG Shipyard has invited new bids for the debt-laden assets. Remember, the Committee of Creditors rejected a resolution plan submitted by Liberty House for the second time yesterday. Liberty House's bid was disqualified as the resolution professional found out that one of Liberty House's entities had been declared as an NPA. The committee and the resolution professional now have less than 2 weeks to complete the bidding process, as the 270-day deadline ends on the 28th of April. Following the deadline, the company may have to go into liquidation as per the rules of the IBC. And we'll have a special discussion lined up on the insolvency process and where do equity shareholders stand in the entire process. That's coming up at 1:45 with Cyril Shroff and Abhizar Devanji. That's a conversation that Menka Doshi will lead. Deutsche Bank has decided to call off plans to sell its retail and private wealth business in India. Remember, Deutsche Bank was in talks with IndusInd Bank for a potential sale. George Smith Alexander of Bloomberg News has this report.
So what we understand is that Deutsche Bank has called off its talks with the IndusInd Bank. The German bank was supposed to sell its retail and private banking units to IndusInd Bank. As far as the sale was concerned, it was a portfolio of around 30,000 crores. What we understand is the sale has been stopped or has been shelved because of a change in management. The earlier management wanted to sell down the India units, and with the new change in management recently, they are deciding to holding back this piece. Also, Deutsche Bank was also not very happy with the pricing of these units. And actually, if you look at Deutsche Bank India, it's quite a profitable unit in that way. It's among the top 4 income-generating units of Deutsche Bank globally, and also even on Asia-wide scale, it's apparently the second largest. So all in all, I mean, if you look at the Indian operations, they are doing quite well.
Thanks for that. DLF is said to be in talks to sell retail assets in Noida and Delhi to the recently formed GIC venture. The Mall of India in Noida and DLF Place in central Delhi are among the assets in question. Dhwani Pandey of Bloomberg News joins us with the details. Dhwani, what have you picked up?
Hi. So basically, the company had done this transaction with GIC last year, wherein GIC picked up 33% stake in the rent-yielding assets of DLF. And last quarter, the company had also come up with a investor presentation where they mentioned that they have identified 2 assets to be transferred to the new GIC venture. So Mall of India is in Noida, which is 2 million square feet, very high rent yielding asset, as well as DLF Place, Saket is also a very prominent mall in New Delhi. So these 2 assets are being, currently in discussion to be transferred to this new venture, GIC venture.
All right. Also, you spoke with Saurabh Chawla, who's the CFO at DLF. He promised to announce some of the land monetization plans soon.
Correct. So basically, there has been a concern among the equity analysts, especially Morgan Stanley came up with a report some time ago saying that company has a very huge land bank, but it's very concentrated in NCR, and that they need to come up with plans for monetization of those land assets. So Mr. Chawla basically said that they will be announcing some strategy on what kind of residential projects they are lining up and how do they plan to basically monetize this large land parcels. This will be done after the 4th quarter results very soon.
All right, Dhwani, thanks so much.
Thank you so much.
IFCI wants to cut stake in the National Stock Exchange. The infrastructure finance company has invited bids from merchant bankers to manage the sale. Sajid Mangad is here with us in the studio. Sajid, they've been doing this in bits and pieces,
That's right. Last September 2017, they said that they would be selling at nearly a percentage of NSC over in one go or in tranches, and that's what happened in Jan 2018. They sold around 0.2%. Now they were inviting bids from merchant bankers on a competitive basis to sell another 0.25% of the stake in NSC. If you look at the timelines, they're looking the entire bids to come in by May 14th, and post that, once the bids are approved, they have to go to the NSC board, because NSC is still an unlisted company, and there is a fit and proper criteria which has to be looked at before NSC board approves any shareholder. So that would happen. So it will take at least the second quarter, end of the second quarter, or also end of calendar year second quarter to finish the deal. But going by the valuation last time that IFCI got of 925.1, it's roughly around the deal size would be 112 crores they're going to get, but that gives a valuation of nearly 43 to 44,000 crores for NSC. Now it depends. We need to see whether the valuation goes up from here or not, because the earnings for the full year would offer NSC will also come in by then, and that will be a kicker going forward. Basically, you have all the HNIs and some of the opportunity funds. Last time IIFL opportunity fund all picking up stake in the anticipation that NSC will list in 2019, and that would give them a premium on listing. So around 15 to 20% premium is what is they're working on from whatever they buy from the over the counter market.
Some of the other financial institutions have held stake in NSC, have thought they would wait for the IPO, but since the visibility on the IPO has been pushed back a little bit, maybe some of these small chunks would come into the market.
So it is going to happen. It's happening over the counter. There is a lot of sales which is happening on NSC, and that's primarily because when the prospectus was filed, they were looking at a market cap of nearly 45,000 crores. Now that's available in the OTC market, so they are planning to exit there. Again, there is nothing much with respect to timeline of when the IPO will come in. It's only an expectation that the SEBI completes the probe, and then they accept the consent plea, and then the work starts. But then again, the NSE will have to file a fresh RHP or DRHP to go ahead with the IPO.
All right, Siri, thanks so much. Let's move on to earnings. Cost pressures may have weighed on ACC's earnings performance in the March quarter. The cement major is expected to report an operationally weak set of numbers with a decline in both profits and margins. Nikki Mirchandani is standing by with a sense of what analysts are pricing in. Nikki.
Sure, I'm going to quickly run you down through the basic numbers. Well, revenue is expected to rise as much as 13% for this counter at a number of 3,508 crore. And also, if you look at the EBITDA, that is also expected to come down by as much as 9% to a number of 380 crore as compared to nearly 416 crore that we've seen in the corresponding quarter. Margins are expected to contract for ACC at 11% as compared to nearly 13% that we've seen in March quarter. Profitability is seen down by 11% to a number of 189 crore. Three other parameters that we like to keep an eye out will be your volume growth numbers, which are expected to rise as much as 5%, which is a muted growth year-on-year basis, to a number of 6.93 million ton. EBITDA per ton is seen declining by as much as 13% year-on-year basis to a number of 549 rupees, and realization per ton is also seen up, however, at 8% to a number of 5,062. Apart from the volume growth, we like to keep an eye out on the pricing commentary that the company will come out also in terms of the capacity utilization, in order to figure out the kind of depressed pricing that we've seen entirely for the cement pack and the upcoming demand that could factor in the capacity utilizations.
All right, thanks so much for that, Nikki. Now, the Finance Ministry has, of course, acknowledged that there is some shortage of cash in certain parts of the country. Both the government and the Reserve Bank of India issued statements on Tuesday saying that the situation is temporary and that they are prepared to handle higher demand for cash. But what caused this in the first place? We spoke to Principal Economic Advisor to the government, Sanjeev Sanyal, and he did acknowledge that there are some signs of hoarding in the system, hoarding of cash, that is. And he went on to assure that if at all there are any concerns of depositors losing confidence in banks, then the government will do all it can to reassure the citizens. Listen in.
Some extent, the amount of money going out is not the extent is not coming back, which shows up obviously in the proportion of cash to GDP. So, but you know, this while this we have watched this happen, I am not in a position at this juncture to speculate on exactly what caused this to happen. And you know, as I said, our first response is to make sure everybody has adequate cash for the time being. We can, you know, and even in the normal course of things, you do get, you know, periods where unusual things happen in an economy. So one shouldn't begin to read too many things into it. Nonetheless, if we do find that this was something that needs further investigation or policy action, appropriate action will be taken.
Is this coming from the same states where we are seeing a currency shortage, you know, talk or evidence of money not coming back into banks?
Yes, of course. I mean, that is where the shortages came. So that is certainly the case, yes.
You know, there has been news flow in the past 6, 8, maybe even 12 months, which has not been entirely positive for depositors, whether it was the deposit insurance bill and the fracas around that, or it's the concern about bank health. I don't want to say that that's having an impact on depositor psyche, but still, is the government mindful of those concerns, and is it doing anything to alleviate any concerns, if at all they exist?
We are always, if the citizenry is concerned about something, it is our business to allay it. So let me clearly state this again. If there are shortages in cash availability in a bank or otherwise, this is not a reflection in any way about their solvency. We have in the last year or so carried out a major cleanup of the banks. This was a good thing in that we forced the recognition of bad assets. And now, as we go through the insolvency process, using the IBC and the code and the NCLT courts, we have begun to clean up the banks, begin to auction off and liquidate these bad assets. Some of this has happened just in the last few days. So, if anything, we are cleaning up the banks and putting them on a much better footing than ever been. So, rather than get concerned about this, you should in fact look at the fact that we are now in fact cleaning up them and putting them into a much better state. And in any case, the the availability of cash in the system has nothing to do with all of this. This is, as I said, a logistical problem that is now being fixed, and we will fix it. Yes, we were taken a little surprised by, we were certainly surprised by this sudden spike in demand, but we are more than in a position to supply whatever cash is necessary for whatever reason by the public at large.
Right. The Indian Prime Minister has touched down in London today. It's a packed schedule for Modi, who's going to be in the United Kingdom for just a day. It kicks off with bilateral talks with Theresa May and will end with another outreach event for Indians staying in the UK. Ian Marlow of Bloomberg News joins us from Delhi for more. Ian, what are the key issues that could come up for discussion?
Yeah, look, for the UK, this is clearly about sketching out its post-Brexit vision of a world order, and they want India and other Commonwealth countries to be part of that. Indian businesses, as everyone knows here, are big investors in the UK, so they're going to be looking to increase trade ties and get Modi on board with their vision for this after they leave the EU. For India, they'll probably be pushing. Modi will probably be pushing visa liberalization for students and workers, high-tech workers working in London, and that sort of thing. So that's probably going to be on the agenda for Modi, pushing closer trade ties and seeking investment in India, and also visa liberalization.
All right, Ian, thanks so much. That's Prime Minister Modi's trip and the agenda there. That's a wrap on Power Lunch today, but coming up next, what happens to minority shareholders when a company goes into insolvency? It's a question that many investors have been asking. Menka Doshi will try and answer that. She's in conversation with Cyril Schroff and tax expert Abizar Divanji of EY.